This year, more than most years, we have two massive forces colliding, one positive, one negative. And the positive, of course, is this whole AI technological revolution that's underway. The negative is the kind of the crumbling and failing old system of too much debt, printing money to support everything. This is a massive tug-of-war right now.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation and it will just take a few minutes of your time. Again, that's wealthion.com/free. Hello and welcome to Wealthion. I'm Maggie Lake. Joining us today to talk about the risks and opportunities for the remainder of 2025 is Brett Rentmeester, founder and managing director at WindRock Wealth Management. Hey, Brett, it's great to see you.
Nice to be back. Nice to see you.
So what's top of mind for you as we sort of gear up for this final stretch of the year? Because I think everyone's kind of hitting the reset button. What do we all need to be thinking about as we look over our portfolios?
Yeah, you're right. As everybody kind of comes out of summer break and kids get back to school, the mindset changes and everybody gets serious about, this last chapter into year end. And I think this year, more than most years, we have two massive forces colliding, one positive, one negative. And the positive, of course, is this whole AI technological revolution that's underway that a lot of people are still waking up to and trying to figure out. The negative, also obvious, is the kind of the crumbling and failing old system of too much debt, printing money to support everything, and the worries that come along with that. So this is a massive tug of war right now between some of the positive things developing and the worries that come along with what we've built as problems in the past.
Yeah, that I love that because, and I think it's sort of represented, right, in you're getting sort of some of these tech earnings and NVIDIA, and then you've got Fed drama sort of playing out as part of the representation of that old system. And it is hard. They feel like cross currents. And I think a lot of people feel like they're stuck getting buffeted and sort of stuck in the middle of that. So let's start with the risks, because I think let's address the fear that some people have, and then we'll go into some of the opportunities. So where do you see the greatest risks in this sort of clash between the new and the old?
Yeah, I think right now it's valuation risk. And, let's acknowledge that because there are these cross currents of positive things and negative things, big forces colliding, you can kind of see in the market what you want to see. And, these things resonate with me. I read the people saying we're at tech bubble valuations and all that makes sense. On the other hand, resonates with me the transitional force that AI brings. So I think valuation risk is the main risk as we enter this fall. And just to put something in perspective, the major risk is still currency devaluation over time. And that is to say, the world has too much debt. They're going to keep printing money. The value of currency goes down. That puts interest rates at risk, creates inflation risk. That is the big risk over time. However, when we look back the last couple of years, we've identified different risks by year generally. So it wasn't too long ago, 2022, our big focus was interest rate and inflation risk. It's not that it's gone away, but that was the year when inflation popped up strong, rates were rising, right? 2023 was banking risk. You had Silicon Valley Bank fail and other things that got kind of swept under the rug, but the remnants of that are still being felt a bit in tight lending due to that period. So that took us through 2023. 2024, end of 24 into this year, a lot of our models were warning of downturn recession type risk. And we had a little bit of that in the first quarter. Now you could chalk it off as tariff concerns, but the reality is the data really softened, and now everything's been pretty strong. And I think really now it's looking at valuations more critically given the run up.
So I think this is, you're really zeroing in on what makes people nervous, because when we're talking about valuations, it's super immediate to people because a lot of us hold a lot of equity in our portfolios. So that idea that we may be kind of on this march or getting carried along in a bubble that's going to burst is really worrying, because we know how damaging and how much wealth destruction there was with the dot-com bubble bursting. So How are you unpacking that? How are you thinking
Yeah.
about what that valuation risk looks like, or how is that going to play out?
Well, let's do a little bit of a comparison to the tech bubble for those of us that invested through it and lived through it. There are some reminiscent fact patterns here. One is you always get concerned when just general valuation measures get extended. So we can look at a lot of different things. We can look at the forward price earnings ratio. Our data shows about 22 and a half times earnings. The tech bubble, it got up to 25 times earnings. So maybe a little less, but in the ballpark. You can look at price to book. What's the price relative to the assets of a company? We're at about 5.3 times. Tech bubble was 5.1 times, so higher. You can look to concentration risk. And this market, much like the tech bubble, is being driven by certainly the Mag 7, so-called Magnificent 7, but the top 10 constituents in the S&P 500 represent 38% of the S&P, with NVIDIA being the largest at 8%. So anybody indexing, just putting money in the S&P, 8% of that's going into NVIDIA for every dollar. So anytime you get kind of a concentrated market like that, with high valuation, it doesn't mean it's going to collapse, but it should put people at a little more of a defensive mindset of, okay, when do I take profit? What are some other things I can do to mitigate risk? I think whether this is the tech bubble 2.0 or not, we saw a mini version of this back in 2022. In 2022, the NASDAQ sold off 32.5% roughly. And that was a period where valuations got extended and earnings weren't keeping up. So, right now, that is the negative, that we sit back and this is not a cheap market. People have missed the first big push higher. Doesn't mean it's over, but is there a risk of, too much hype and things disappointing first before, bigger gains? I think the answer is yes.
As part of our silver interview series this month, we're bringing you top tier research in a free silver investment report. To claim your free silver investing report, simply click on the link in the description below. And if you're looking for a simple, secure way to invest in physical gold and silver, check out Hard Assets Alliance at hardassetsalliance.com. Speaking of silver, Wealthion will be on the ground at the SCP Resource Finance Global Silver Conference this October in Toronto, where Eric Sprott will deliver the keynote address. It's going to be a major event for silver investors, so stay tuned for more details in the weeks ahead. Yeah, this is the issue though, right? Because in fact, we just had Jim Bianco on for a conversation, and he, I think, spoke to that sentiment because he was at a party or he was somewhere and everyone was talking about NVIDIA. And of course, they know he's in the market, so they were asking you about it. And he stopped and said, what do they do? What do they sell? What's their product? And they were like, it's up 500%. So people just know it's a winner and they're in it. This isn't like they're going to combing through the balance sheet, buying into, the future of AI or their positioning on their next chip. But if you have tried to get out or sit out, you've missed huge gains. And so,
That's right.
it's so hard to make a decision to step out of the market. Even in April, the professionals got out and were worried about valuations and all of the things you talked about. And they missed that big rebound. So
That's
how
right.
do you deal with that when clients come to you and try to sort of, balance those two issues, fear of the bubble, but fear of missing out of what could be
Yeah.
great gains?
Well, in our experience, valuation has never been a great short-term indicator of whether to be in or out. It's great long-term. If you had a 200-year horizon and you just could sit back and put money in when things were cheap and sit in cash when things weren't for 10 years, 20 years, that's probably the right way to invest. But the reality is it's never been a great near-term indicator. Said differently, things can stay overvalued for an extended period, or they can sit undervalued for a long time. But it is a major factor in long-term return expectations. So over time, it matters. Now, I think what people have to look for is does this turn into a euphoric kind of bubble? What I would say so far is the market's very divided, right? Some people are making a lot of money. There's certain stocks that have led the way, but there's a lot of stocks and companies that are, near their COVID lows of 2000, 2001. So it's become a little more of a winners take all kind of market. And I think what you want to look for, one caution sign would be, going back to the tech bubble. it got to a point, maybe you recall this, in the fourth quarter of 1999, that it was just euphoric. And I looked at the data to remind myself the NASDAQ in the fourth quarter of 1999 was up 49.1% in one quarter. That's how crazy it got.
Yeah, that's just insane.
Yeah, you forget that. People felt like they had to be in. It was up 50% in a couple months. And that was like the blow off top. And then there was a slow grind for 2 years that saw the NASDAQ lose 80% of its value. Mm-hmm. So I think in an overvalued market, one thing you can do is look for euphoric behavior. Are we there yet? I mean, this is the debate, right? But truly euphoric behavior, like end of 99, I think is like everybody recognizes, whether they want to admit it or not.
Yeah. One of the issues, I just want to ask you about this, because I think this is what makes this debate so interesting right now. Back in the dot-com bubble, which is what we call it, because part of that euphoria that you just mentioned was like any company with a .com on its name could IPO and raise zillions of dollars and get backers, whether they had a business plan or not. Looking back in hindsight, we realized that some of them didn't really have businesses, except that we all understood the internet was radically changing things and disrupting things. People point out now, this time around, that listen, these are not companies with a .com name or an AI name and nothing. Some of these companies have earnings. They're making money. You can argue about whether the CapEx cycle is topped out, but these are, they are delivering on their earnings. There are some real things about the fundamental backdrop that support these kind of valuations. So there are some positives out there, aren't there?
Oh, absolutely. And let's expand on what you said with earnings. I mean, the second quarter earnings came in for the S&P at a double-digit annual growth rate. Greater than 80% of the companies beat earnings. To put this in perspective, a couple of years ago, NVIDIA was sitting there at 150 times price-earnings ratio. People thought it looked ridiculously expensive. Well, since then, its PE has come down a lot, but the stock's up a couple multiples of where it was. So now you could still say it's expensive on paper, but it's got a forward PE ratio close to Costco, So the point is, to your comment, if you really can deliver the earnings, what seems like high PE ratios can come down dramatically. And I think people are underestimating this AI revolution, in a lot of respects. And, one side of it that I keep coming back to is it seems like this is a bigger race between nations. There's an acknowledgement that whoever kind of controls the future of AI might be the winner. Mm-hmm. And with nation states involved, what are the limits of how many dollars can be pumped in? I think it could take things further faster. And when you look at the technology adoption curve of AI, every technology goes through an adoption curve. AI is outpacing cryptocurrencies, which had been the fastest, internet adoption, cell phones, et cetera. So it's moving quicker. And, the next phase of it is something none of us really understand. I mean, we can speculate on, but it's kind of this move to what people are referring to as AGI, or artificial general intelligence, which is essentially the point at which AI has the intellect of a human and can do most things the human mind can do. And this progression right now, again, most people see it as, I use AI to supplement what I'm doing, like a co-pilot, sitting there when I need it. That's evolving into agents. Now I'm putting AI in programs that can go out and do things on my behalf. And if you believe the Elon Musk vision of the future, 5 years from now, that'll be in robotics all over the world that are intelligent. So, I don't want to, when I point out all the valuation stuff, I still think there's great promise here. I think investors just have to, be smart and not get caught up in a hype cycle and end up, taking a big haircut before some of these promises play out.
Yeah. Yeah. And this is, I think, the aspect of doing your homework or having an advisor that's doing that deeper research into, what's real and who's best positioned to ride that, I think is going to be really important. And I feel like we're not quite at that yet, just because so many people are kind of passively chasing the NVIDIAs of the world. Not that NVIDIA doesn't fit in that, but that's just the point. Like, do we know that? Before we dive into maybe a little bit more specifics on that, I just want to ask about this macro environment, because you kind of mentioned that this is about sort of nations and now a national security issue in some way, which I completely agree with. What is the macro backdrop sort of one of the positives supporting the market, or is it a risk or both? Because we have not only the Fed, which seems like it's going to be in play here, in terms of what they decide to do with monetary policy, but also the role of the government in terms of pumping liquidity and trying to stimulate growth, right? So is that a positive that also is supporting?
Yeah, I think in general, all the push towards a technological revolution is a positive because we're calling it AI, but it goes beyond that, right? We're seeing the beginnings of huge advancements in robotics, huge advancements in drone technology.
Yeah.
Space is becoming a sector people are talking about. It's all very early, but we can imagine, the world ahead. So I think those are all positives. But we can't forget about the debt burden and the obligations of the past. So it's very difficult to just grow your way out of 50 years of overspending and debt. But what I will say is, so that's why I say it's a very mixed environment. It's hard to figure out right now because you could make very valid arguments on either side. One of market's probably going to go down because look at the valuation levels we've gotten to, right? That would be the traditional way. And also on the other side, it could be, hey, the AI phenomena is going to make all boats rise for a while. I think the other factors we look at, though, Maggie, we do look at things like earnings. Earnings have been beating. And you get into trouble when you have high expectations, high PEs, and earnings start disappointing. We haven't seen a lot of that, at least from the AI leaders, right? But we also look to more fundamental things in the global economy. And in the US, it's interest rate driven. I mean, we do have all this debt and obligations, so interest rates matter to a great degree. Now, the 10-year Treasury is at about 4.3% at the time we're recording this, which is higher than where we've been over the last 5 years, but well within a normal band of kind of where we toggled between the last couple of years. So we look for stability there. If that broke out above 5%, we might get a little more concerned because of the interest and financing costs, not only of the government, but trickling down through the economy. Likewise, another thing we look at that we think is very important in this market are credit spreads. And that is how much risk are lenders taking? When credit spreads are low, it suggests they don't see a lot of problems out there and they'll lend to a less than a credit-worthy person at a relatively low rate. Those credit spreads are extremely tight, close to the tightest on record. So you could interpret that right now as smart lenders, banks, institutions aren't seeing a blow-up risk in the immediate future. Now, it's famous last word. Sometimes these credit spreads go from being very low to all of a sudden there's a big event. So I think you watch these things and you do get more defensive if interest rates start rising, potentially in the 10-year rate, or if credit spreads really start blowing out, or if earnings start disappointing amongst kind of the leadership of the market today. And right now, you've got a pretty benign environment where none of those things are rearing their head just yet. But it's a nervous kind of bullishness, right? You're sitting here knowing with perfect hindsight that we look back on the tech bubble and say, well, it was ridiculous that people stayed invested through that. Why weren't they, moving out of it? So it's a period of caution as well. It's navigating very cautiously through a very exciting technological revolution that's right in front of us.
Yeah, which is easier said than done, right? So I know that, and it's great to have, I think, for all of us to have some of these signals to watch, like on our dashboards, when you start to see some of these things moving. But I know that you probably want to be preemptive in terms of managing these risks. So what should people be thinking of in terms of strategies that they're either doing or, importantly, asking their advisor if they're sort of prepared ahead of time to make sure that they're able to navigate the risks, especially if things start moving quickly? How do you think about readiness?
Yeah, it's a great question. I mean, as a firm, I can tell you this: when it's a period like this that we're still excited about a lot of things, but valuations are concerning us, we're not necessarily getting out wholeheartedly out of positions, but we're actively taking gains. So if you've got something that was 1% of your portfolio a year ago and now it's 6% because it's been a huge runaway winner, we're pulling that back. We might not be getting out of it, but we might be saying, hey, you're at 6%, pull that back to a more reasonable level. So it's being more active on trimming, taking profits, even if you're not going to get out of core positions. Um, I think it's also about having enough non-correlated or other things in the portfolio besides just U.S. equities. I think people, the average investor has relied too much on the U.S. stock market, and I think there's real risk there. So I think it's assessing overall how much in equities as a total. And I think what individual investors oftentimes run into is they kind of let everything run. And in good times, that's great. And in bad times, they really get hammered. So contrast that with an approach where you're letting things run, but you're taking kind of prudent profits along the way and rebalancing and repositioning. So, I mean, in our world, people shouldn't have 80% of their portfolio in equities. They should have hard assets. They should have private investments. And the equities they have, they should be mindful of taking gains when things really are, running to the upside. As it relates to AI, one other thought. We do have selective AI companies, but we don't like chasing things. So, we're not in an environment where personally we would be chasing the top couple stocks just because they run up. But there are thoughtful ways to get involved with AI. One is if you have access to venture capital, startup companies, they're investing in a lot of these startup ideas that are likely to get acquired over time by AI players. So AI centric, you might be overpaying for a startup company. Maybe it's valued at 50 million, maybe it should have been 30, but it's relatively limited compared to is something $1 trillion overvalued or not in the public market. So that's one way. Second way, again, this is access through probably an advisor or your own network, would be there are some pre-IPO kind of companies. So private companies that are not publicly traded, but you might be able to get access to things that are already proven. There's all sorts of companies out there. I mean, a good example would be something like SpaceX or some of the Elon Musk type companies that clearly they've proven their position in the market. These are not small companies, but some people will invest in those with the expectation that at some point they'll be public companies and they're a little bit more de-risked than doing startup plays, right? So I only point that out because it's not just a question about chasing the NVIDIAs of the world. There's a lot of layers to this AI story and even beyond AI, like I was saying, robotics, drones, space.
Yeah, no, absolutely. And it's interesting when you're talking about make sure that you have things that are not correlated just to the US equity market or I think the idea of hedging is something that a lot of us have not been used to. And again, I think more tools available through an advisor maybe than if you're doing it on your own, or although it's certainly possible. How does crypto fit into all of this for you? Because I think people
Yeah.
sometimes think of it as chasing the gains, and sometimes people are thinking about it from the correlation lens.
Yeah, I mean, listen, crypto is in a very similar situation to how we describe the valuations in AI. And that is to say, historically, the cryptocurrency markets have moved in a pretty distinctive 4-year pattern that was related to the halving cycle, or when the inflation rate cuts in half going forward, which happens about every 4 years or so in Bitcoin, at least. And that tends to set the stage. So in a very similar vein, a lot of the gains have been made. I mean, you go back and losing track of time, but it wasn't that long ago. Bitcoin was at $15,000, maybe 2 summers ago, right? And it's been volatile, but we're at 112,000, maybe that kind of ballpark today. So, the easy gains have been made. Doesn't mean it's over, but we have to be aware of the cycle, kind of the same thing to AI, the valuation we're at relative to the timing. The normal traditional 4-year cycle would suggest there could be one more run up and it would peak sometime this fall. And then we should be prepared for a little more downside and choppiness. Now, there are some that believe that that's changing because of institutional money coming in. So, I think it's the same kind of thing. You try to take profit along the way and you focus on what percent of your portfolio is in that area and is at a comfortable level, right?
Yeah.
So if your cryptocurrency exposure overall is in a comfortable level, it's not this is not saying you should get out of it, but you should be very aware of not letting that drift to an uncomfortably high level.
Yeah, higher than
So
you're comfortable with, especially in this newer area. I also think it's on the reverse, right? If you are looking to gain exposure and have not done so, you don't want to like move a whole pile of chips in, maybe, especially if we've got an opportunity to buy lower coming later in the
yeah,
fall or through the winter, a more cautious approach, maybe.
Yeah, now the dilemma is always, even with crypto, that historically near the end of the cycle is when a lot of the big gains occurred. So, it's you're fighting two forces. The calendar suggests by late fall you should be getting a little more cautious and wary of the cycle. On the other hand, you know that the typical cycle is Bitcoin moves first, then Ethereum, and then all these alternative coins historically have played catch up. We've seen Bitcoin move. We've seen Ethereum move now, maybe not to its full extent. And now the question remains, are we going to have a traditional altcoin season where a lot of these other coins play catch up and we see more exuberance? But now it's a dangerous time period too, because with exuberance comes speculation in both AI and crypto. So, again, I think the future is bright for these two areas, but investors just have to be smart about when they are adding chips to these areas and when they're taking profits off. And we're approaching a little more of a cautious period into this fall.
Yeah. And I love that you guys have been in this space so long and so have that sort of understanding of these cycles. So let's rifle through some of the themes that you're going to be thinking about in the different asset classes. And again, this isn't advice. You need to talk to your advisor, and we'll tell you a little bit more how to get a free review at the end. If you want to sort of check in, which you should. But what are some of the themes that you are going to be thinking about at WindRock when it comes to at least equities? I'm sure you're trying to look at some areas that maybe have been overlooked in this AI surge.
Yeah. So equities specifically, and again, just reiterating, not investment advice, just examples here. Certainly some technology, AI related things that are part of the future, acknowledging the valuation risk. Offsetting that, certain sectors that still are kind of stodgy, dividend paying, maybe a little bit out of favor. For us, it's been categories, just generically, such as tobacco stocks, such as pipeline companies and energy plays. And then pairing that with really some areas that have growth potential, but have been pretty distressed and ugly. More recently for us, that's taking a fresh look at cannabis stocks, which are still a growth industry, with some positive catalysts perhaps ahead. But have
They've
been
had a
beaten
big
down.
move recently, though, haven't they? I
They
know that
have,
you were. I spoke to I think Chris about this, but you
yeah,
were, and then I think immediately afterwards it exploded. So is
that's
it
right.
has it happened? Has the move all happened, or is there still room for
We
that?
don't think so. I mean, it's the same kind of caution. It's a lot easier to get into something before it moves 200% or something than it is after it's moved. But the reality is, anytime you look at some sectors that are 80, 90% off their all time highs, even with a strong move, there's probably a lot of room if the thesis is right. So, for an investor, these are just examples, but a little bit towards the growth and technology, but countering that with more solid companies that are dividend payers, and then kind of sprinkling in things, if you're comfortable with, that are a little more distressed in nature. But I think the biggest takeaway is really reevaluating your overall equity allocation. I think most US investors have too much in equities today and are too US centric in what they're
Yeah.
doing.
Oh, this has been a consistent theme that got a little sidelined when we had the big rebound in
Yeah.
U.S. Equities following April. What about bonds? This seems like it's been a super tricky space.
It has. It has. And to be honest, when you go back to kind of the COVID period when interest rates went I'll call it near 0% and even negative in Europe, we really moved away from owning traditional bonds. I know there are a lot of advisors that kind of had a mindset of you just have to be in bonds, market's efficient, prices it at, the fair rate, but it just didn't make any sense to us to have obligations that paid you basically nothing back. Where we sit today is we are still very concerned long-term about interest rate risk, the debt levels, and kind of like we were talking about, the crumbling of the old world system until we get some resolution on how that's solved.
Mm.
So we've kind of had what we call a barbell strategy, which means you have some things at one end and some things at the other, kind of like weightlifting, where the weights are at two extremes. On one end are just short-term treasuries. We're not taking interest rate risk. You're just clipping your 4 and change percent coupon and rolling it back into 3, 6, or 9-month treasuries, just kind of liquidity. That's been part of our solution. But we've paired with that the idea of going out there and taking private credit risk, finding vehicles where you can lend money And at least on a projected basis, expect somewhere in the 8 to 12% range. Now, you're taking on different types of risks, oftentimes in private markets, but these are mimicking bond-like vehicles or obligations where someone's paying you a fixed rate. So that's kind of been our mindset. But I think the key takeaway would be we would not be taking on tremendous interest rate risk. We would not be owning long-term bonds. And at some point in the future, U.S. Treasuries, government bonds might come under pressure. But again, we're watching 10-year Treasury rates. We're watching credit spreads for signs of that. So we might, behave differently if things like that move around. I'd also be very cautious in kind of so-called junk bonds. Those have historically, performed pretty strongly in periods like this because these credit spreads have come down, meaning these bonds have gone up. But to buy in today, I think, is a much more dangerous proposition.
Yeah, because if we see some cracks, that it's gonna show up there and quickly, and then you've got to worry about liquidity and making a move to get out. So I know when we're thinking about diversification, I think you mentioned this earlier. You mentioned real estate. I'm always so interested when I hear that because it makes me kind of knee jerk think of commercial real estate, which extend and pretend, I think is still a ticking time bomb and unless it changed and no one told us. So what do you mean by real estate? Do you have to be really, really careful where you're going, or is commercial part of the distressed area that you would consider?
Well, we certainly invest in and consider commercial real estate, but I think it's too broad to just say commercial real estate. It's kind of like saying stocks.
Yeah.
Are we talking like German stocks or U.S. stocks? Are we talking tech stocks or energy stocks? It's just such a broad category. I think most people, when they hear commercial real estate, they're thinking office buildings in major cities. And that is been the ticking time bomb where they just haven't recovered post-COVID yet. There's debts that might not be able to be paid. There's this extend and pretend game, as you alluded to, going on, where lenders know the building's not worth what they say, but they know it's their problem too. So they're kind of like allowing the borrowers to tick by. So I don't know. We're not rushing out at this point to invest in major cities and downtown urban areas and office. That's not where our focus is. Our focus has largely been on rental real estate for individuals in Sunbelt states where people are moving. I think there's been a big push. We've seen it from COVID on to move to like sunshine and freedom states where taxes are lower, weather's better, all of the above. And a lot of these cities, have had not enough rental real estate for that demand. Now that ebbs and flows, but I think when you sit here today, that's still a very valid thesis. And we approach it with build to rent real estate. So these communities that look and feel more like single family homes, but are really rentals where people don't need down payments, are not maintaining their properties like you'd have to with your own home. And we still think that's a very bright area ahead, in part because when you look at the data today, the cost of owning is much higher in a lot of these markets than the cost to rent. So it's kind of upside down from what it, historically is. Along with that, there's a couple other areas. I mean, we still are doing selective, I'll call them efficiency hotels. For anybody that's traveled recently, I mean, hotel prices are skyrocket, to the moon and back. So sometimes it feels painful. Ridiculous. And a lot of U.S. families are going to travel, but can not pay $500,000, $600,000 a night, some of the things you see. So there's this whole segment that a lot of the hotel chains are focused on, which is they're going to have 5-star accommodations all the way down to efficiency style, little kitchenettes, cheaper stays off the highway. So the Marriotts, the Hiltons, et cetera, their whole portfolios are expanding to consider things like that. So we've been involved in a number of those. And lastly, it sounds boring, but it's an income producer. It's like the traditional grocery anchored center with services. That's probably not going to go away because you're still going to go get your hair cut somewhere. You're still going to stop in for groceries more often than not. So those are 3 sectors within real estate that we continue to invest in, but we are very cautious on the urban centers, office buildings. I mean, people will do, I'm sure, innovative things. There'll be some great deals to be had. So it's all about the price. But we're seeing major office towers, the ones that are selling, at huge discounts to what they were carried at a number of years ago. So I still think it's an area for experts only. Like if you know what you're doing in that sector and you really know that city, we've tended to just kind of stay away from that for now.
Yeah, no, that's great. It's so great for you to sort of really break down that real estate market because you're absolutely right. We sort of group it together. And I think when you're having a discussion about your portfolio and you hear that, we all kind of, recoil because we know
That's right.
some of the problems, but you're right, it's so enormous that there are, a lot there's a lot to choose from there. Especially if you're choosing wisely. So let's round it out with that hard assets. We know we
Yeah.
love to talk about this because it's first of all, it's been a winner. And when we have a lot of these cross currents and concerns, people are thinking about, do I need to have that? Am I underexposed? So I'd love to hear your thoughts on whether you think most people are underexposed, but what in that area looks promising? We've seen a big run up in gold and silver. Is that over? Do we need to think about other types of hard assets? How are you thinking about that space?
Yeah. Well, first, just answer your first question. People are massively underexposed. I mean, the average U.S. investor has very little in what we consider hard assets. Hard assets aren't always as easy to buy as stocks. And, the traditional 401k plans and things, they're largely locking people into kind of a stock and bond paradigm.
Yeah.
So you don't always have choice. But again, thinking about the big macro factors, we have this huge debt bubble globally. Governments are going to have to print money and devalue currencies to make good on that over time. That should push up the value of things that are somewhat in limited supply, that can't just be printed out of thin air, that are not just paper claims, paper assets. So we continue to think gold and silver are, critical pieces, precious metals to a portfolio. They both had a great run, but you can make strong arguments why they're still undervalued relative to the growing money supply. So in other words, you could say gold's up a lot, but is it up a lot relative to the growth in debt obligations in US dollars? No. It's kind of going to track the amount of monetary growth, and the amount of monetary growth in the world keeps expanding. So we think that's a critical area. Again, not investment advice, but as a category. And we like other areas. I mean, this one sounds like real estate, and it is, but it's also food. It's farmland, which
Mm.
again is not easy for the average investor to necessarily invest in, but we do investing in that space, and ranging from owning traditional farmland to plays where you're buying farmland, converting it to organic over a multi-year period. And, that little pint of blueberries in the grocery store is about double the price once it's organic. So that kind of comes back to profit for the farm owner. So those are two areas that we remain interested in, and I don't think it's too late. Again, I think you have to be strategic on when you put new dollars in, your timing. But I think if you're closing your eyes, opening them up in 5 years and saying, what are some areas that you ought to be in? Those are core areas to us.
Yeah, and I can attest to the food prices as someone who's been shopping all summer for, adults, young adults and growing teens. It's been sticker shock for sure. So
Yeah,
at least there's a way to lean into that on the other side of the ledger. Brett, this has been such fantastic insight. Thank you so much. I mean, it is a really important time, I think, for us to all stress test our investment strategy and make sure we're prepared for what comes next, right? Information is power. So thank you so much. If you would like to do that, just a reminder, you can get a free portfolio review from Brett and the team at WindRock. Just head over to wealthion.com/free. Brett, thanks so much. Appreciate it.
Thank you.
Thank you all for watching. We'll see you again next time.